Welcome back to another episode of Smart Investing. I am your host, Jaden Brains, founder of Brains Capital. And if you clicked on this episode, then you're interested in learning more about the pros and cons of prop firms. Because in the previous episode, I was mentioning them on how they're a potential opportunity for you to learn futures if you're willing to get started. And I would love to dive in more into the pros and cons to see if it really is a good fit for you and if you should deploy a little bit of your capital in learning futures. So my opinion on this is very unbiased. I've gathered facts on both sides, and I've been through it, the highs and lows of these prop firms. And so I will be giving you guys some unbiased details. So first off, let's just jump into the cons to make the end of this episode a little brighter, a little more happy. So the cons, it is very difficult. I just want to point that out. It seems very alluring and very easy. And a lot of people get ideas in their head that this is how they're going to become rich, is through futures trading with prop firms, but that is just not the case with this. So around 4% of all accounts pass, which is pretty absurd because you would think it's like 50-50, where there's a trailing drawdown and there's also just a profit goal, and you think, oh, people could just full port it, which is another word for just going all in, all the chips are in. But it is not as simple as it seems. And I'll get into it why it's difficult. They're set up in a way that is similar to a casino where it benefits the house more than us as investors. And well, obviously, they need to make money. If it didn't work for them, they wouldn't keep doing it. So the majority of people do lose. And so that's just a risk up front that you have to know. That you got to know what you're getting into, that there is a major risk at play here. All right, so the biggest reason why people fail these prop firm accounts, these challenges, is because of the relative drawdown. So the trailing drawdown is like a minimum amount of money that you can lose, or a max amount of money that you can lose before your account just cancels, and then you'll see order rejected. And that's when you can no longer place trades, and in order to basically keep trading on that account, you'd have to pay a reset fee, which can be anywhere from $80 to $150. Depends on the size of the account too. It can be up towards $200-$300. And I mean, the majority of the time, it's honestly easier just to start a new account. It's typically cheaper, especially if there's a promo going on. So instead of resetting, you should always just buy a new account. That is not financial advice, but it's just an opinion. You'd have to look at the numbers, but the majority of the time, it is cheaper. That is one thing. I would look for promos for these things. If you're going to jump right into it, there are different platforms that do offer promos. For example, Apex Trading right now, I think this is the last day, but you can basically get a 250K account for around $17-$18, and then it's around $80,000. It's around $80 once you pass to convert it to a funded pro account. But I mean, still, even if you do it 10, 20, 30 times, it is very difficult because of this trailing drawdown. For example, if you're at 250K, the max trailing drawdown is 6,500, I believe. But it's not just if you go down to 23 or 235. Oof, man, I can't speak. And it's not only if you go down to $233,500. If you go up to 251,000, or did I said 243,500? I hope so. Anyways, if you go up to 251,000, now your max trailing drawdown is 244,500. And this goes on up until $256,600. At that point, it's $250,100 is your max trailing drawdown. The reason why this is so difficult is because if you were just a full port, you put all your money in one basket, all your eggs in one basket, and just go to the moon. If it goes up to 260,000, but then has a sharp pullback down to 253,500, then your account bottoms out and you would have to reset it back down to 250,000. So that is what makes it so difficult, is that trailing drawdown, because you can be super successful for 3-4 days straight, but if you have one bad day, even if you're at 264,500, it doesn't matter. That 6,500 drawdown is now just 6,500 less than your maximum. And that makes it very difficult to pass these, because you'd have to be consistent throughout it up until you get your $15,000 profit goal, or if you're on a $50,000 account, to your $3,000 goal. And it's harder than it seems. And a lot of people that get into it buy a bunch of accounts. They're like, oh, look at this discount. I'm just going to full port and go to the moon. Or even I'm going to full port 5 accounts long, 5 accounts short. Sadly, they do not permit you to do that. They will ban you if you're shorting and longing at the same time, which is unfortunate. And also, you'd be surprised that it's not that simple because of the trailing drawdowns. And because there will be fluctuation, there will be some volatility in the market, and one bad wick will send you under that trailing drawdown and you'll be canceled. So, and another con is their consistency rules. So once you have passed an account, you're now funded or have a pro account, whatever it be, you're going to have similar rules, and your profit target's going to be around, depends on how big the account is. For a 50K account, you have to make it up to 2,600 before you can withdraw. And their consistency rules is that they require you to have somewhat of a strategy. You can't just full port it and hope for the best that it goes up to $2,600. You actually have to maintain a consistent contract size. So you can't do 3 this time and then 10 the next and then 20 the next. You have to maintain it at 3 or 10 or whatever it is on average. So yes, you can vary it up a little bit depending on your confidence in the trade, but the consistency rules, they can actually deny your profit request, your withdrawal request, if you're inconsistent, if you don't have stop losses, which is another reason why traders fail. And so they can actually deny your request, which is unfortunate, but they claim that it's because they want you to be an actual trader and not just a gambler or speculator or whatever. They actually want you to learn how to trade, but that honestly just makes them more profits. So whether or not it's a scam, it's actually kind of good for people because it'll help you actually develop a strategy and learn how to trade, which I support 100%. But it kind of sucks when you see a random opportunity and you're super confident, want to full port it, and you make a lot of money, but you will not be able to cash that money out. It is with the wind. All right. So now let's get into the reasons why traders fail. Actually, before we do that, let's just do the pros. The pros, you can get funded for cheap if you become a great trader. So you're only going to pay a minimum amount of money to make maximum gains because you can stack your capital. You can start multiple accounts. For example, you can have 20 $50,000 accounts on a lot of platforms, and which equals $1 million in capital, right? And so if you're consistent, you can link those accounts, have them all be one giant $1 million account essentially. And once you hit that 2,600 on all accounts, you can make a withdrawal. And so that's beautiful. I think the software's around $150 to be able to link all those accounts together, and one trade goes on all of them. And so if you have developed a good strategy, you're doing well, you're consistent, you link the accounts and you hit a profit goal, then you will have a pretty big cash out. You're gonna be sitting pretty. The only downside to that is that if you have a bad day or a bad week, then all your accounts are going down, which would be unfortunate. All right. So let's see. Also, it's just a cheap way to practice. So instead of just putting your life savings into that account and trying to figure out futures and having to learn the psychology of it, you'll go through the psychology fails and you'll bottom out your accounts, but it's not your money. You already paid that initial fee up front, and that's what you lost. You didn't lose thousands of dollars that you could have lost otherwise. So that is a huge pro of these funded accounts, these prop firm accounts, these challenges. Why do traders fail? So that relative drawdown is one of the biggest reasons, but there's a lot of psychology and just technical analysis fails. I'll get into it. No stop losses. That's one of the biggest ones. People just full port and they just want to send it, and they don't have a stop loss, and they see it continue to drop. They're like, oh no, it'll go back up. It doesn't go back up. Keeps dropping, and their account hits that trailing drawdown and they get stopped out. So that is one of the biggest reasons. Make sure you have stop losses, that if you're speculating a U-turn on the market, that you set your stop loss slightly above where you would consider yourself to be consider that trade to be a failed trade. So whatever it be, if you're going for longer moves, then you can adjust your stop loss accordingly. But yeah, make sure you have that, and so you have a defined risk to reward with your trades. You know how much you're risking and how much you're willing to let that go on in order to maximize your profits. Having TPs, which are take profits. So typically people will have 2 to 3. Solid traders will see a break. It's in their favor. They'll withdraw a little bit of their profits to secure something. they'll typically move their break even down, or their stop loss down to their break even. So if it reversed on them, they wouldn't lose on that trade. They already took a little bit of profits, and the rest of it is at that break even. But if it continues to drop, then it hits their second take profit. They take a little bit more out of their contract. Keeps dropping, they'll take more. So they're kind of bleeding it out. They're liquidating it. And sometimes good traders will just leave, just a runner. That's what they call it. And they'll just let it go on as long as they can to maximize this trade, go for 40, 50 points, and just to have one or two contracts, whatever it be, just bring in some huge profits, especially if it's still in accordance with what you thought was going to happen, your thesis. And so that's one of the reasons also is just no defined strategy. Most traders don't know what they're doing, and they're just doing one contract or 100 contracts, whatever it be, and they're just putting it in. They're like, oh, it looks right. They think that the odds are in their favor when it really is not. All right. A lot of this has happened to me many times too, is when I get close to just close to passing an account and you're nearing that profit target, then you start to get a little antsy and you make an unnecessary trade in order to pass, and then it just completely reverses, and now you're a wreck emotionally and you try to make up for it. You increase position size, and then it goes even worse against you, and then you hit that trailing drawdown and you want to cry because you almost just passed an account, but instead you bottomed that account out, and it is so sad. But changing that strategy in your thesis just because you're close to that profit target is foolish, and it'll come back to bite you. Close to that is just over trading, just too many trades. When I trade for too long, it's usually a mistake. I've set my hours just to 7 to 9, just to maximize my quality of trades from those 2 hours. And after that, I'm done. I will stay out. That's when the market starts to consolidate a little bit. There's less trends, and it's easier for me at least to lose money if I continue trading throughout the day. I get tired, eyes start to hurt, but I'm still trading because I think I see opportunities when really, it just bites me in the butt. So over trading is a killer. Make sure you stick to minimum amount of trades, and so that you're not fluctuating like a child, but you're actually being a real trader and looking and studying trends and trying to catch waves instead of just ups and downs throughout the day. Emotional side of it is something that, you can read as many books as you want on the emotional side of trading, the psychology, the mindset. But until you're really in those positions, you can't really train it. It's something you have to go through. But once you get caught with just being emotional, you have to correct it. You have to study your past mistakes and see why you did what you did, and not let it become emotional. The thing that works best for me is just becoming a systematic trader with my stop losses, take profits, having a system in place that helps me take good trades and get out when I'm supposed to be, and to take as much emotion out of the trades as possible. So that's really it for prop firm accounts. So if you guys have any more questions on prop firms, or if you're just want to hear my recommendations of firms that I like, just DM me at marketpulse.io. That's on Instagram, marketpulse.io. And you'll find me there. Just send me a DM and I'll get back to you as soon as I can. But thanks for listening. Here's my ghetto disclaimer that you guys haven't heard in a while, that this podcast is for informational purposes only. It does not constitute financial, investment, or legal advice. It's all personal opinion and experiences. Seek your own research and advice from qualified professionals if it comes to that. And I do not guarantee the accuracy or completeness of the information shared. And I'm not responsible for any actions taken based on the content of this podcast. It's all risky. As Jim Rohn once said, it's all risky. And my past performance is not indicative of future results. And I'm not responsible for any losses or damages that may occur as a result of investments made after listening to this podcast. Love you guys. Thanks for listening. And I will see you the next time I have something cool for you guys.